And so I love dispelling these myths. I call them myth conceptions. And in this episode, I'm going to dispel the myth that when using the banking concept, and if you don't know what that is, stay with me and I'll explain it, that somehow whole life insurance is superior. No, it doesn't even hold a candle. And I'll help you understand why. So get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans become their own banker, okay? But optimize their assets and minimize tax and understand how money works. So in this episode, let me show you that if you want to become your own banker, which is incredible when you understand this, get ready to be blown away if you have never heard this before, that when you use Index Universal Life, it blows whole life insurance out of the water. You can do it with whole life, but it's lackluster, okay? So you have to understand, first of all, how money works before you can understand banking. Now, there's basically 4 things you can do with money. You can spend it, you can lend it, you can own with it, or you can give it away. Now, what I do is I double dip. I own and loan on the same assets by becoming my own banker, okay? And so let's make sure you understand why bank, credit unions, even insurance companies are so willing to pay interest. Their greatest assets are actually their liabilities, okay? So if you have a bank here, the bank is willing to borrow OPM, other people's money, and they'll pay you, let's say, 4.5% on a CD. Now, are they just a benevolent institution paying you that interest? And they put your money in a vault? No, what do they do with your money? They put it to work, okay? And so they might even loan it back to you at 7.5% on a home equity line of credit. So that's a difference of 3%. They have overhead. Sometimes they only net 1%. And there's, people out there say they'll do all that for 1%. Absolutely. They make millions and billions of dollars doing what I'm showing you here. This is how to become your own banker. You're borrowing money and paying a low interest, and you're using that money to make more interest. That spread or that difference is called arbitrage, okay? Where you're making more than the cost of the funds. But when you think about it, if a bank, credit union, an insurance company, a financial institution stopped paying interest, stopped borrowing money and paying interest, they would wither up and die, okay? Their greatest asset is their liabilities. If they stopped having liabilities, they would stop having assets and money being made, okay? Sometimes you need to understand, an employer knows that you hire an employee and you hope the employee makes you more than they cost you. If they don't, your days are numbered as the employee. But see, that's a return on employment cost. Would you hire an employee for $100,000 if that employee made you an extra $200,000, $300,000, $400,000? Yes. Do you hurry and save money by firing the employee? No, now you're giving up 200, 300% rates of return on the cost of the employment, okay? Would you buy a widget machine for $50,000 if that widget machine made you $100,000 every single year? Yes. You're making 100% return on equipment costs. Okay. Now you need to understand that or you're gonna miss out, okay? So here we go. Banks, they borrow $1 million of OPM. Back in 2008, they were paying even less than 1%. But let's say they pay 1% interest on the million, because this includes money even in checking accounts, which a lot of banks don't pay any interest on checking accounts because that's a demand deposit. You can demand all your money in that account. So they're going to pay $10,000 a year in interest on every million of money that they borrow, OPM. Now, they're very willing to do that. Why? Well, in 2008, when 400 banks went under, 900 more were on the brink of going under, the federal government asked the 5 major banks in America to disclose where they had their Tier 1 assets. That's money they have to have on hand, liquid and safe, in case of a run on the bank. Guess where they had 30 to 40% of their Tier 1 assets? In insurance companies, where I put my money, because they're rated 5 or 6 notches higher in safety. A lot of banks back then were rated BBB, and they take your money, put it in insurance companies, and increase the safety to AAA, and they got credited 5%. 50,000. How much more is 50 than 10? How much more is 5 than 1? Don't say 4. It's 500%. Now, it's a 400% profit, but it's a 500% return. Would you hire an employee for 10 grand that made you 50 grand? That's a 500% return on the employee's cost. Would you buy a widget machine for 10 grand that made you 50? That's called a 500% return on equipment cost. It's a 400% profit, okay? Now, here's me over my lifetime. I've probably borrowed on real estate, let's say, at an average of 6%. Some years I borrowed as little as 3 3/4 in 2008. And I've also borrowed as high as 18%, but it's tax deductible in my tax bracket if you learn how to do it correctly, okay? Because I always make sure that I can itemize and deduct it greater than taking the standard deduction. Now, I don't have time to explain that here, but you can deduct the interest, but it's not contingent on being able to deduct the interest. Because if I borrow at 6, all I have to earn is 6 or higher compound interest, because this is simple interest. If I borrow at 6 and earn 8, how much more is 8 than 6? Don't say 2, okay? I'll pay an employee 60 grand. If that employee makes me 80 grand, I'm making 20,000 profit. That's 33% profit. 33% more than 60, okay, is another 20 grand up to 80. Are you getting it? Okay. But if I can tax deduct that in a 33% bracket, it's a net cost of 4. Now, on my max funded IUL, golly, it's pretty much a no-brainer. I can earn 8, okay, net. How much more is 8 than 4? Don't say 4, it's 100% more. You getting it? Okay. Now, in low interest environments like 2008, I was borrowing at 3, a net cost of 2, okay? And I was earning 10 by rebalancing on my IUL. How much more is 10 than 2? 500%. So the banks make 500, I make 500, we're both happy. But you can't believe how many Americans miss the boat because they don't understand how money works, okay? Now, the primary key elements of a prudent investment are, number 1, liquidity, the ability to access your money when you need it. Number 2 is safety, not only of the institution, like the multi-trillion-dollar insurance industry where banks put their money for safety, but also to earn a rate of return. A rate of return either greater than inflation or rate of return greater than the cost of the funds when you are using the banking concept, okay? Now, that's why I use property structured max funded IUL, because it has liquidity, safety, rate of return, way better than most other investments by far. That's why I call it a L.A.S.E.R fund, which means liquid assets safely earning returns, okay? So often I've taught people how to make 100 to 300% returns on OPM like banks do. So if you're not getting it yet, let's go to 2008. Banks, if they borrowed $1 million and paid 1%, that's 10 grand a year. If they turned around and only got 4% by putting it into insurance companies, how much more is 4 than 1? Don't say 3. They're making 400% more than the cost of the funds. If I borrowed at 3 3/4 tax deductible interest in a 33% bracket, that was a net cost of 2.5. I was making 10. I was making 400% too. That's all I'm saying. We're both happy because I understand how to become my own banker. Now, my house in 2008, December of 2007, I could see the writing on the wall. I could see that we were about to maybe have a collapse of the mortgage meltdown, which happened. My house was valued at $1.5 million. And I went in and I refinanced that house, 80% loan to value on a first mortgage. And also the last 20%, I borrowed on a second and third mortgage, 100% loan to value, okay? If you have good credit, you can do that. On the first mortgage, okay, 4.5% interest, tax deductible, a net cost of 3. Now, I don't care if I can't deduct it, I'm paying 67. And on that $1.5 million, okay, I'm earning 8%, that's 120. I'm making tons of money, more than the cost. If it's tax deductible, I'm even making more, 75,000 profit the first year. This is the first year. It gets better than this as it starts compounding. So far, so good. Well, on the second and third mortgages, let's say I'm paying 6%. Now, my house went down in value by the end of 2008 down to $1.1 million. Okay. Now, what people don't understand is I had critics that went, neener, Mr. Andrew, you're underwater. You owe more than your house is worth. Did I care? I was in control. See, if I would have left my equity in the property, I would have lost 400 grand for sure, guaranteed. And it would have taken several years before my house went back to $1.5 million. I didn't lose anything. That 400,000, let's separate that 400,000 that I would have lost had I left it in the house. It's out here in my IUL. Let's say I borrowed that at even higher interest, 6%. Tax deductible, it's 4. I'm paying 16,000. I don't care if I get unemployed. I don't care if the house gets destroyed in a natural disaster. I'm in control because I can peel off half of what I'm earning. If I'm only earning 8, I'm earning 32,000 tax-free on that 400 grand. I only need half of what I'm earning to make the mortgage payment. The mortgage company loves me. They don't have to worry about me. They're not going to foreclose on me. Everybody else that lost their equity and lost their job, they lost their home in foreclosure. See, I'd rather, if I lose my job, I'd rather have a $600,000 house with $450,000 of liquid cash in an IUL than to have a lower mortgage balance and no liquid cash. Because try to go borrow on that house when you don't have the ability to repay. It's a lot better to have and not need than need to not have. Does that make sense? Now, this is how to become your own banker. So, is not only a personal residence, but rental properties. I've helped many real estate landlords refinance their properties. And I did that back in 2012 with this gentleman to resurrect tax deductions to offset the money we were taking out of his IRAs or 401ks. And we got it out basically with no tax. Every $1 million, every one of his rental duplexes that he refinanced for $1 million, okay, he separated $1 million of equity that was trapped in the property earning Zippo, okay? Because the property is going to increase or decrease in value regardless of how much equity is in it or whether it's mortgaged to the hilt or free and clear, okay? Equity has no rate of return in the property. You only give it a ability to have a rate of return when you separate it. Every $1 million that he separated, every one of those properties he refinanced for $1 million and got $1 million cash out into the IUL. He borrowed at 4.5%. He was able to tax deduct it. You can tax deduct it on rental properties. So he pays $45,000, but he gets $15,000 back in actual real money tax savings because he writes off $45,000. And so the net cost is $30,000 is what it cost him, 3%. He was earning 9% on his IUL. How much more is 9 than 3? Don't say 6. 300%. You know, he's like, Doug, you're making me so much money, I can't, see, if you're getting it, it doesn't matter if his rentals are vacant. How can you make money on a rental property when it's vacant if all of your money is tied up in that property? You're not making anything. But if his properties are vacant or it gets destroyed in a fire or a hurricane, he still is making 3 times what the mortgage is costing. He's still making 300%, even if it's vacant, okay? That is how money works. Now, when you have money in an IUL, we call it a laser bank. So if you have $1 million of cash value, we have savvy business owners that they can go borrow using their cash value in their IUL as collateral. Could they withdraw $1 million? Sure, but now it's no longer in there earning interest. Why do they borrow? Because they're smart. See, they're not really borrowing their money. They're borrowing from the insurance company because the insurance company will loan them $1 million because there's $1 million of collateral sitting there. They don't have to qualify for a loan. They don't have to have good credit or anything, okay? So the insurance company loans him $1 million, okay, or her, and they give him 2 options. You can borrow at a 0 cost. So we'll charge you 2% interest and we'll credit you 2% on the $1 million that's collateralizing this loan, okay? And so they charge you 2, they credit you 2. Why do they even charge you? Because if they don't, it's not tax-free. It's not really a true loan. So you have to abide with the IRS, so it's tax-free. But most of our savvy business clients, they use what is called the index or alternate loan, especially if the economy is doing well. So it may be a higher interest rate. Why would you have higher interest? Let's say 5%. That's $50,000 instead of $20,000 in interest. It's because now the $1 million isn't credited the same 5. It's credited whatever the indexing rate is. And some years it could be 0, but other years it's 10, 20, 25, 61%. If you borrow at 5 and earn an average of 10, how much more is 10 than 5? 100%. Okay? Now, let me show you an actual example. In 2017, had a savvy business owner. He understands how money works. He uses his IUL as his working capital account. That's his foundational asset. And then he uses the money in his IUL to seize investment opportunities. He likes to buy properties, fix them up and flip them. And I'm talking about big strip malls or shopping centers. And so he called and said, Doug, I need $1 million out of my IUL. Well, what he really means is I need to borrow $1 million using my IUL as collateral, okay? It's just semantics, but he calls up and he says, Doug, send me the form. The form is a one-page form where he puts his name and his policy number, which is like his account number. And it says, okay, do you want to withdraw $1 million? No, because then it's no longer in there earning interest. Do you want to borrow $1 million from us, the insurance company, using the cash value as collateral? Yes. Do you want the zero cost loan where we charge you to, credit you to? No. You can charge me 5 in 2017. So he borrowed $1 million and agreed to be charged 5%. That's 50 grand. He doesn't have to write out a check for that 50,000. Why? Because it's automatically deducted from the money in the policy, which grew that year. It capped out at 25%. So the $1 million that he left there as collateral got credited $250,000 of tax-free interest. That minus the 50 is a net of 200,000. He netted 20% tax-free return on the $1 million that he used to collateralize a loan where he bought, fixed up, and flipped a real estate property to make $2 or $3 million. You talk about double dipping? Yeah, that's all legit. That is how money works. Now, why is this better than whole life? Whole life can't even hold a candle to this, okay? I've never seen a whole life policy that you can actually borrow, and the insurance company, if they charge you 5, will credit you 25, or like in the year 2020 to 2021, credit you 61.33%. And some of our clients got credited 158% because when there's anxiety, there's opportunity. Most whole life policies that use the banking concept, if you borrow at 5, they'll only credit you 4, or they'll charge you 6 and credit you 5. They'll credit you even less than what they're charging you. Oh, but you can use it tax-free and you're paying yourself back. That's what they think the banking concept is. Even if they let you borrow at 4 or 5% and credit you 7 or 8, there's only about a 2-point spread. Well, you'll come out ahead. Whole life works. But, oh my heavens, with IUL, you can earn a spread or an arbitrage like this way easier than you can with whole life, because whole life crediting you 25%, good luck, okay? Now, folks, if you want to learn more and see examples of this, study my book, The L.A.S.E.R Fund. And this will help you understand how money works and why the L.A.S.E.R Fund knocks the socks off of so many other investments. And there's some myths out there, and I want to dispel those myths. So watch all of the episodes where I dispel these myth conceptions. But if you want to study, I recommend you get a copy of my book, The L.A.S.E.R Fund. It retails on Amazon for $20 up to $60. And if you buy it on Amazon, I want to thank you, but I'll gift you a copy for free. You just simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little skin in the game, and then I'll pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those educational formats available for your investment. You can even schedule to attend a free educational webinar that we teach on a weekly basis, no cost, no obligation. You can even schedule an appointment with an IUL professional that we train and oversee that will help you design a properly structured max-funded IUL so that it will perform at its utmost best so that you can become your own banker.